Hi, this is part 4, I believe, point 4 of the importance of international economics series. This is unit 1. Um, so this time the video will genuinely be short, unlike the other videos, because the topic that we're going to cover today is already has an entire unit dedicated to it, the unit number 4, the balance of payments unit. So yeah, let's get started. So balance of payments, right? So what is the balance of payments? Before we discuss what's balance of payments, let's take a look back at all the things that we discussed before this, right? Whatever we discussed prior to this topic, it was all in terms of, okay, one commodity is being demanded, other commodities being supplied, or in exchange rate we discussed how money, the currency is demanded in, and the currency is supplied, and all these factors were in terms of demand and supply. However, this is the first time wherein the actual value of the commodity in terms of US dollars or Indian rupees or whichever country we are talking about, the domestic currency of that country will be used in this balance of payments. And this is kind of the financial aspect of international economics. Here's where accounting and bookkeeping and all of this comes into play. So, what is the balance of payments? According to Salvatore Dali's book, the balance of payments is a summary statement in which, in principle, all the transactions of the residents of a nation with the residents of all other nations are recorded during a particular period of time, usually a calendar year. Long statement, very easy to learn. Any long statement that you get, you basically dissect it and try to fit each part of it into a puzzle of sorts, and kind of try and understand what that statement is trying to explain. So the balance of payments is a summary statement. Okay, this is part 1, summary statement. Why do we call it the summary statement? Because a country, all the people of India, right, around 1.7 billion, if I'm not wrong, yeah, 1.7 billion people of India, I think it's 1.3, I'm not sure. So, but then the 130, 140, 170 crore, that's the population of India, all of these people are transacting with different relatives and different friends and different people all across the globe. And we all know like Indians are present everywhere, right? So it's impossible to keep a track of all these transactions in a statement, right? You can't keep every single transaction tracked. That's why it's called as a summary statement. It summarizes all these transactions, and it categorizes them into major chunks so that it is easier for the government to calculate the balance of payments and calculate all these numbers. So next, in which, in principle, this is very important, in principle, because okay, let's be honest, there is the gray market, there is the black market that is there in perhaps every single country. It might be true that, you know, some of us as well, the people who are watching this video, might have asked one of our relatives to bring something for them from another country, let's say the US, the United States, and then in order to evade the import taxes, you might have asked them to, okay, unbox it there and bring it here, and so that customs doesn't catch them. And yeah, so in principle, they try to record all the transactions, but in reality it might not be true. So all the transactions of the residents of a nation, okay, with the residents of all the other nations, all the transactions of the residents of a nation, let's say select a nation, India, so with the residents of all other nations, so except India, whichever country's residents that Indian residents deal with are their transactions are in this summary statement, which is called as the balance of payment. are recorded obviously during a particular period of time. So a particular period of time basically means a fixed period. Yeah, this is not something that needs to be explained. Usually a calendar year. Sometimes it's the fiscal year, sometimes it's calendar year, depending upon the government. So balance of payments, why does it require an entire unit on it, right? Because every country's rules and regulations are different. We all know that accounting methods are different for every different country. Sometimes some countries follow their own method, sometimes they follow the international method, IFRS. So it's difficult to kind of bring a uniformity of sorts. However, the IMF and World Trade Organization and all these huge institutions and organizations try to bring uniformity by having key points. So it has to be a summary statement, residence of the nation, and particular period of time. Now, before we discuss this, let's go back here. Residence of the nation, this is kind of the toughest thing to understand in this whole balance of payments thing, right? In Unit 4 also you'll understand that. It's very difficult to categorize the residents of the nation, because if someone has migrated to another country, they might be defense personnel or they might be wage workers. They've just went, so their income has to be added into the balance of payment. But sometimes some people who live outside the borders of India over a certain period of time and are no longer part of India's income category, and their deposits are supposed to be treated as external donations. Donations is not the right word, but external deposits. And then sometimes gifts which are given, or donations which are given to Indian institutions or people of India by someone living outside of India, are also supposed to be included in this. But it's a mess of sorts. Accounting in general is supposed to be very difficult at such a large scale, and including the fact that there is like a proper black market and there are grey markets which function kind of. It's dicey whether it's legal or not. It's questionable. The legality is questionable. So this residence of the nation is one of the things that really will kind of challenge you in the future. But it's kind of once you get the hang of it, it's really easy to understand. So next, features. So yeah, balance of payments does have credits and debits. It does follow the double entry bookkeeping system, and it consists of current account and capital account. Now, the first 2 points are pretty clear. I mean, we've been dealing with debit, credit, and double entry bookkeeping for quite a while now. And basically, double entry bookkeeping is where let's say India buys something from USA. In India's books of accounts, it will show as a purchase, and in their books of accounts, USA's books of accounts, it will show sold. And India's books of accounts, there will be a credit of US dollars, and in USA's books of accounts there will be a debit of US dollars. So they'll receive the amount, whereas we'll spend the amount. So that's double entry. And consists of current account and capital account. They have their own unit again, so I won't spend a lot of time here. Wow, 8-minute video, quite short, because of the fact that this will have an entire unit for it. There's not much that needs to be explained in it. Thank you for watching. Yeah.